12 o'clock noon, so we're going to go ahead and kick off the presentation. Today's presentation called Piercing Through the Noise. I love that title. That's what Brian has called the presentation for today. And so it's really great because a lot of the work that ITR does is really to help you to, like, first of all, identify the noise. What's the noise you should pay attention to, what you should ignore. And a lot of the work we do at the Baird Generational Wealth Group is to help kind of cancel out that noise. And so this is going to be, I think, a really interesting presentation, and I'm glad you're here to spend the time with us. My slides can advance. So I never used to talk about Baird that much, and I'm not going to talk a lot about Baird today. But when I started with Baird, we had less than 1,000 employees. Today, over 5,400 associates. Since I'm going to spend some time talking about private business, I thought everybody should know I'm a big owner of a private business, and so that's something that's part of my life, part of my balance sheet, and the way I think about the world. So the things that Brian talks about, I apply not only to our clients' situations, but also to my own situation. Here's our contact information. You'll have plenty of time to, as you listen, to answer, to make any questions you want. There's a Q&A function on the Zoom. There's a survey that we'll be asking you to fill out at the very end, so hopefully you'll stay for that. You can write any questions on that. If anything comes up that we don't get to, in terms of answering your question, please feel free to email me directly or email Brian, and we'll make sure that your questions get answered. So without further ado, I'm going to turn it over to our guest presenter today, Brian Beaulieu from ITR Economics.
Thanks, Chris, and great seeing you. Always enjoy working with you. We go back, I don't know, 12, 15 years now.
Yeah, we're 15 now, Brian. Wow.
Yeah, it's been good.
All right.
All right, so this is what we're going to be looking at. We're taking a look at the macroeconomic signals, and 23 is virtually done. GDP growth in the third quarter is going to slow down here in the fourth quarter is the way it looks. And we're going to see the US and some global economies gradually decline in 2024. It looks to be a mild downturn. Europe's already in decline. Russia's already in decline. Who knows about China? But we are not yet in decline. Supply chain pressures are easing because demand is easing and inventories are up. And I know it doesn't impact everybody watching this webinar, but manufacturing new orders are weakening to the extent that they're now running below year-ago levels. Manufacturing production is running below year-ago levels, and that's a big deal. That's a sign that the underbelly of the economy is softening up. I'm not sure that the Federal Reserve cares about that. They don't seem to. More on that later. Some of the, tension points, if you will, uncertainty drivers, the war in the Middle East, the Hamas attack on Israel and Israel's move against Hamas. People want to know, what is this going to mean for the U.S. economy? And so far, our analysis is it means nothing for the U.S. economy. Not from the macroeconomic sense. It will take the war broadening out and oil prices shooting up for the Israeli-Hamas war to have a material impact on our economy. And I watch those oil prices every day, WTI, Brent, et cetera, and they're right where they were before the war started 32 days ago. So we haven't seen a disruption in that regard. We know because we measure it that LNG is continuing to move from the United States over into Europe, easing some of their energy concerns, although this may be a tough winter for them. But the Middle East isn't interrupting our outlook one way or the other. The election is an uncertainty driver, mainly because that's going to be where the noise really gets amped up. Politicians during the election cycle have a tendency to misstate the facts. That's how I'm putting it. They want to tell the truth, but they just tend to misstate the facts. And we're going to take a look at some of those facts before they even get a chance to talk about them. Corporate profits are running below year-ago levels. And to me, that's a big deal. They're coming down off of record highs, and that's always of some solace, I suppose. But when corporate profits are beginning to weaken, you'll find that they freeze. They'll delay projects. They'll delay acquisitions. They'll just take a pause. Combined with these high interest rates, if there's any leverage involved, you have a situation that leads to uncertainty and a slowing in the economy in 2024. What does this mean for you is that there are going to be opportunities out there. This is a mild downturn. So when you look at that forecast, it's not a license to accept decline in your own business in 2024. It is a clarion call to outperform the economy. Knowing your competitive advantages has always been key with us at ITR, and that's going to be more true now in 2024 than you could believe. And this is a great time to be getting some strategic planning done. We see the economy going up in 2025. We see it going up in 2026. You need to be planning on that. As always, this is our report card, how we did for 2022. And as always, we don't change that first column. They are what they are. Those series don't change. And duration is 18 months. So we laid down that GDP forecast in June 2021. By the end of 2022, we had the 98.9% accuracy rating. Housing is the worst one on this list at 84.8, and that is clearly my fault because I am the chief economist of ITR Economics. And while we all knew interest rates were going to be going up, we had no idea, or at least I didn't have any idea, that they were going to go up as fast as they did, and that banks would be jacking those rates up as fast as they did. And that obviously had a big negative impact on the housing market. We'll talk some more about housing, and we'll certainly be talking some more about interest rates. But this is what the forecast looks like out through 2025. There's no change to our forecast. That third quarter GDP number was good. It came in about 1.1% above our forecast average, so it beat our expectation. But when I tore the numbers down, I got a different impression than the headlines were doling out. The number one driver for that increase in GDP was personal consumption expenditures on household items, rent, utilities, healthcare also is included in there. In other words, it was taking from discretionary funds and diverting it into non-discretionary funds because of the inflation that was going on in those items like utilities and like rents and food away from home, which is up amazingly right now, by the way. The second largest driver was private inventories. Non-farm private inventories went up significantly in the third quarter. And while I know how they compile GDP, and I understand why that's a plus for GDP, it's not a plus for businesses, because those of us that run businesses, see businesses, you know that when you have excess inventory, something's going to change, and it's not going to be you accelerating your production or your distribution. Is going to be clearing out this inventory so that you can free up the cash that's tied up in that inventory. So I was not impressed that that was such a major driver for GDP growth in the third quarter. As a matter of fact, I looked at capital goods investment, machinery, CapEx, and that was a negative in the third quarter. That was a drawdown on GDP. So we see the consumer pulling back in some sectors, and we see CapEx going negative on us. That wasn't clear when you just looked at the headlines for this third quarter GDP. Also helping was the automobiles were up 16.8% in the third quarter relative to the year ago third quarter. But other things like appliances were very, very soft. I look at non-durable consumer good new orders, and they are slipping. So we looked at all of that, and I said, we really don't need to change this forecast. The deviation that I just told you about works itself out by the time we get to mid-2024. The general thrust of this is that 24 is a mild decline. It's not going to be like the Great Recession or COVID or anything else like that. We think the economy is going to be rising in 25, 26, 27, 28, and 29. And that's the far biggest story is, are you ready for that sort of rise? Manage your way through this softness, and then figure out how you're going to blast your way up in 26, 27, 28, and 29, when we're still going to be faced with a people shortage, when interest rates are still going to be higher than we got used to between 2010, 12, and 2020. And asking yourself if you have enough energy to still drive the business like you have been driving it. I mean, that's part of this whole silver tsunami aspect of things that's going to be going on. We still have 2030 in our sights, and time permitting, we'll talk a little bit about the 2030s, but nothing really has changed along those lines. Let me see if I can advance this slide. There we go. Because we're heading into the silly season, aka the presidential election cycle, I dusted this off and updated it, and what you're looking at are different administrations, starting with General Eisenhower. Red is Republican, obviously. Blue is Democrat. The asterisk you see underneath Kennedy Johnson and underneath Carter is simply to designate that they had the good fortune of having a Congress that was Democratic underneath both of their administrations. Every other administration, there's always some friction there. It's never an aligned government. And you can see how the average per annum rates of growth have slowed through time. It certainly isn't even. But look at the last 4 administrations, and Biden's obviously simply to date, but 1.9%, 2.0%, 1.8%, 1.8%. Very, very different presidents, different Congresses, yet the ability to grow doesn't seem to change all that much. And my point in bringing this up is, don't expect some political economic salvation. It doesn't exist. And 2, it's up to you at the company level to make superior growth happen. Don't count on the macroeconomic scene to drive that growth any more than you would count on the stock market to be the sole barometer of your wealth or the sole driver of your wealth. Just doesn't make sense. You are in charge of you. This is what I was alluding to before about US manufacturing production, which is that lighter blue line, and it's down below the 0 line. It's at minus 0.8. So this is a 12/12 rate of change. If you're not familiar with rate of change, we've taken the last 12 months worth of production index, averaged it, and that goes through September 2023. And we compare it to the 12 months ending September 2022. And for the last 12 months, production is down 0.8%. And those gray orbs show you our forecast for US industrial production. And we're still looking at a relatively mild downturn, but it is a downturn. You can see that rate of change is going to go below 0. Frequently, and a very reasonable question is, how bad is it going to be? This is my way of showing you how bad it's going to be. And if you need some non-math way to gauge that, what you're looking at with those orbs is very similar to what we went through in 2016 and 17 in terms of that recovery trend. That's the dynamic. So now you have an opportunity to ask yourself, all right, what did I do right during that period? And what do I wish I had never done in that particular downturn? And then take it one step further. What signs did I miss, or what opportunities did I miss in that next rising trend that if I had a chance to do it again, I sure would grab on those opportunities? Well, this is your chance to do it all over again. This is a mulligan, if you're a golfer, for steering your businesses through a business cycle trough into the next rising trend. Wholesale trade for durables and non-durables are running below year-ago levels, and you can see our outlook for 2023 and for 2024. Again, it's not onerous. It's on par with what we went through in that 15-16 period. But if your budgets aren't set straight, or if you don't have an aggressive strategy for 2024, it's going to turn into a sluggish year for you, and you're probably going to blow some budgets, which means you have to be very aggressive in terms of market share, in terms of maintaining your margins, and in terms of pricing. And I don't often show this to you, but at this juncture where housing is very clearly negative and people are very aware of that, then we talk to non-residential construction companies and they're very positive. It's just a way of showing that the economy isn't one big glob going up and down at one time any more than you have all sectors of the S&P 500 going up and down at one time. Rarely works like that. Housing is toward the beginning of our train, and the non-residential construction is the typical caboose of our train. And there's about 2 years lag between those two. So housing's just now beginning to pull itself up out of that recession. It's going to be a slow, long crawl up. And non-res is going through its best days for this business cycle, and it's going to feel that red zone, the hard landing, where it's running below year-ago levels in 2025, after housing is back into phase B. And all of us, all the rest of us, we play someplace in between, and that's the current sequence of the different industries. I'm going to take a step back and instead of talking about the US, talk about the world. This is GDP for the US. That's the dark blue narrow line. And then we have the world in green. One's 3-month moving average, one's 12-month moving total, simply because of the way they are produced. But more importantly, we're on logarithmic scale here. So you're getting an accurate percentage relationship of change through time. And you notice that US GDP, that white space, has been closing. Notice that, please. It means that we are growing faster than the world at large, even though we are the world's #1 economy. We are the largest economy on the planet by far, and we're outpacing the planet in general. I'm going to come back to this because one of my bullet points later on is going to be this. You want a sound plan for the future? It's here in the United States, USA all the way, in terms of where I think your business plan should be. I think where your kids should be. And Chris will have his opinion, but I think your investments should be US centric too, in terms of mitigating risk and taking advantage of some demographics and some long-term potential. Even though we're #1 doesn't mean that we're oblivious or we can ignore what's going on in the rest of the world. Here we're comparing the rate of change for non-defense capital goods new orders, excluding aircraft. And that 12/12 rate of change is at plus 2.2. The weakness in the third quarter was in the 3/12, not the 12/12. But you can see that export activity, export of goods to the rest of the world from the United States, tends to lead by 4 months. And those exports have already dropped below the zero line, which tells us that CapEx, new orders, will be dropping below the zero line. And again, the 3/12 has already done that. I think it's worth noting, see that little curl in that green 3/12 rate of change for exports? It's happening at about the same level of 2016. It's not as bad as 2002, clearly not as bad as the Great Recession, et cetera. This is really it's a nice tell in terms of the probable magnitude of decline in not only CapEx, but in the overall economy. This is where I get to wax a little bit longer on China. When I talk to people about China, I find so many of them still have the paradigm in their head of 2002, 2004-ish through 2012, when China was growing so much faster than the United States. This is China industrial production in that dark blue. US is that thicker green line. We're on the same scale left and right on this rate of change. These are 3/12 rates of change. And we could write books. Books have been written about how China accomplished that growth and how they've managed to create twice the living space that they need for a population of 1.3 billion people, how much leverage has been used. And this ongoing stories today about how they are over leveraged, things that we've been talking about for a long time. But I wanted you to graphically see how from 2012 through today, the rate of growth in China has been slowing and slowing and slowing until they're now playing in our general neighborhood. And 4.2% may be as truthful as the day is long, but if you look underneath the numbers enough, you know that they build a lot of EVs that never get sold. They build bicycles that never get sold. And if you read the pages of the newspaper, you know that the government is getting more and more communist and really dissuading private enterprise at a very rapid pace. And money is being funneled into state-owned enterprises that never have to pay it back, and that is hurting the provinces. There's a mess developing in China, economically speaking, but there is a worse mess demographically speaking. The red line here is China's population, and you can see it really peaked out around 2015, and we've been telling you that it's declining. We have this UN data that shows it rather nicely now, and that's UN projection of where China's population is going. The world has never seen anything like this before outside of the Irish potato famine where about 20 to 25% of the Irish population died. And obviously that's devastating. Imagine if you were facing this, the people you could sell to, your customers were just going to become fewer and fewer in number every year. What would that do to your margins? What would it do to your need for growth, for machinery? I mean, it would change everything about how you run your business. And the same thing is true of an economy. The green line is India, and we're very clever with our numbers, our colors at ITR. The blue one is US. And I found this interesting. The US is the third most populous country on the planet. And there's such a delta between India, China, and the US. India has now surpassed China in terms of population. They are the most populous country on the planet. They have their eye on becoming the next China, moving up from the 5th pole position to 2nd largest economy on the planet. They have a really tough battle ahead of them to get there, particularly with the 2030s, not that far away. But this is a significant sea change in power, is what you're looking at. And it's at this time that I really feel obligated to point out that history shows, and while the dynamics of decline here and the size of the economy are without precedent, we have many examples like Russia, declining population. You're going to see China tries to balance out its loss of economic power by becoming more and more militaristic, more and more bombastic, more and more difficult to get along with. And all of this is happening while the US and China's economic relationships are fraying more and more over the years. You know, we used to, China was our #1 source of everything imported before. Now it's Europe. You look at foreign direct investment, we're not investing in China, and China's not investing in us. It's Europe and Canada that's where we're investing, and that's who's investing in us. They're going to be adrift, and that means they're going to become more likely to strike out against either the Philippines or someplace in the Spratly Islands or Taiwan. We don't know, but we know that this sort of a trend makes them a hungry tiger, and that becomes a problem in terms of peace in that region, if not a broader area. Why am I going through all this with you? Why have I just taken 4 minutes of your precious time? Because this is the time for you to make sure that not only you, but your suppliers are no longer depending on China. The #1 strategic initiative in our point of view is safeguarding your supply chains, and that means making sure you aren't dependent upon China. Coming from India, Vietnam, Indonesia, Mexico, or better yet, here in the US of A, is going to get you across the finish line. Relying on this situation, given that scenario, is not going to be where you want to be. There's more people working in the United States than ever before. 12-month moving average, the total rather, it's 133.1 people average. You can see the number of people working in China and what's going on there. And the young people don't want to work. And this is a major problem. You cannot have a thriving economy when you have that sort of a graphic describing the people working within that economy. And Europe has its fair share of problems also. The only country holding up the population trend line really well in the short term are the Brits. But other than that, you're looking at declining populations across Europe, which creates all sorts of stress there also. Negative demographics in China and Europe will be the reason why there is deflation in the 2030s. You know, that's always been part of our forecast, long-range forecast, that inflation will turn to deflation. And that's what the theory said very, very clearly. And took a while, but then we first saw it in China, and the realization that it's very real also in Europe, and the lack of economic conditioning going on in Africa really makes it clear that it's this declining number of people in those two major industrialized sectors of the global economy is what's going to drive a lot of the deflation. And you have to get prepared for that. It's 10 years away. Here's that FDI that I was talking about before. Europe accounts for most of it, the EU Americas, not all of Europe, but broken down by country, you can see it here. And more businesses are being opened up across this United States. And I thought it would be naturally in the southern tier, you know, the right to work states, but it isn't. It's in Michigan, it's in Ohio, it's in Indiana, it's in Wisconsin, it's all over the country. It's even in New York. And for why anybody would want to start a business in New York, it's because they like a good challenge. Notice who's not on this list. China's not on this list. You get down to Brazil, it's only 0.3 billion. China isn't on this list. In fact, China's a negative number. There's been a withdrawal of investments from the United States back into China. And I've mentioned to you that the stress on supply chain is easing, and you and I can both point out particular things like in the electrical industry where the supply chain issues are still tight. But in terms of intermodal container traffic, all 5 ports are running well below their prior capacity levels. Flow of goods is very rich and very real. So China is becoming a problem with more and more mounting risks, as I mentioned, but I want to reiterate, Western Europe is slipping into recession. Eastern Europe is not far behind, and Russia is a hollowed out version of its former self. They're already in recession, and peace should break out in Ukraine. There's always a post-war letdown in any economy, and when you're already in a recession like Russia is, they're going to be hurting for certain, and their bonding with China is probably going to only increase. So look for those nationalist opportunities, and as I said from the beginning, USA is the best long-term plan you could have for your business, in our opinion. Chris, do you want to come up with any thoughts or questions before I go on to inflation and interest rates?
Yeah, I did have a big question, Brian, and I had written this down as you were talking. I mean, so if we think about like each person in the world being sort of a unit of demand, and so that demand kind of drives the economy, and you're talking about a pretty significant fall off in those units of demand around the world, how will that like channel back and impact people here in the United States? I'll get off and let you answer that question.
Okay. Well, I want to clarify a point, and I don't think I did a good enough job. Global population will continue to grow, but it is slowing in its growth at a remarkable pace, driven by the declining population of China, driven by the declining population of Europe. But the population in the Middle East continues to expand very quickly. The population in Africa continues to expand very quickly. So what's the decline in China and in Europe going to mean for the US? It's going to mean that we're going to be more and more isolationists. We're going to be more and more dependent upon our own internal economy. And until we get into the next wave of technology, it means that we're losing some export market activity. But, and this is an important but, the US has never relied significantly on its exports as a means of generating a lot of GDP. China does, Europe does, we don't. So the fallout for the US isn't going to be as significant as it would be if you're looking at these other countries and what it would mean for them if the US was losing that sort of population. The biggest take home here is if you want to make America great, procreate. I mean, that's the thing to do. If you're under 40 years old, you got to do this. This is for America. Go out there and have another baby. That's what you got to do to make us even stronger in the future. Remember that when someone asks you, what'd you learn at the Baird's webinar today? Honey, we got to procreate. All right, talking about inflation. Inflation's coming down. This 12/12 is at 5.1. So that's the annual average index compared to 1 year earlier. The October data came out, I think it was yesterday, could have been the day before, and this 12/12 is now at 4.7%, and the 1/12 rather is at 3.2%. So we're seeing inflation continue to ease. Our outlook here is that if you look at to the right, that 2%, we're going to be below 2% rate of inflation over the course of 2024. And we'll probably get to that 2.5% mark for core inflation as well during the period. But we don't see it going as low as it has been in some of these earlier cycles, like 2008, 2016 even, and because the labor market remains too tight. It's just not going to happen that way. We don't have enough people, and unless we have a bruising recession, labor prices are going to remain on the rise, just at a slower pace. And that means we're not going to get the inflation down to zero, which is ostensibly what some members of the Federal Reserve are really jonesing for. But it should come down enough that we are going to get to see some interest rate decline. Banks were surprised by higher interest rates. I was surprised by how high they went, but not by higher interest rates. This is just a fun chart. You have Paul Volcker, Alan Greenspan, Ben Bernanke, and Janet Yellen clearly telling us where interest rates were going to trend. And somebody had to appoint the tall guy as chairman. We couldn't find another short person really to help keep these interest rates down. I mean, interest rates are not even up to their long-term median in all seriousness. And the end of the Goldilocks period from 2012 to 2022 is clear. We're not going back to the cost of free money. And that means from a business management standpoint, people are going to stretch out their payment terms on you. They're going to be coming at you to lower your prices because the cost of money is now painful to them. Relatively speaking, we've been through these interest rates before. They're manageable, but it's the short-term delta that tends to drive people a little nuts. What you're looking at here is credit tightening for small, medium, and large firms. And if you look on the right, you can see the percent of banks that are reporting tightening credit conditions, and it's already gone up high enough to induce a recession. The gray areas are prior recessions, and we are in that recession territory now. The lack of liquidity from the banks is only going to get worse, we think, and particularly from the small to regional banks, as commercial real estate market conditions continue to deteriorate. You've probably been reading about the mezzanine debt being called. This is the beginning of that liquidity issue that is going to be more acute in 2024. Banks really don't start opening up their willingness to loan again until we're probably in the second half of 2025. At least that's the normal progression of these things. Money supply continues to come down, and I think nope, I didn't on this one. If you let your mind's eye just draw a tangent line from 2008 to 2020, where we are now is with the money supply deflated is right back on that trend. So all the Fed has been doing so far is sterilizing their exuberance or their push on the money supply because of COVID. We haven't even really gotten into the tough part of the money supply in relative terms. I have the 112 and the 1212 on this chart, so you can see that we're not even seeing any tendency to bend that decline in the money supply. This is my way of telling you that while the money supply has been going down for a year, we haven't even hit the tough part of that decline yet. That's going to be felt more in 2024. This is just a little trying to help you out type chart. Commodity prices are down. Look at the 12-12 ready change column. The 312 is there if you want to look at it later. And you're going to get all these charts, so you can study them at your leisure. But commodity prices down, aluminum, iron, crude oil, diesel. But electricity isn't, wages aren't, transportation costs are not. And the further away you get from the steel mill, the more the labor and the power factors in there. So when you get that buyer saying, hey, I need you to drop your prices 10% because I know iron and steel is down 11 or 17%. I'm trying to give you some ammunition to fight back with that says, well, that's only about X% of our total cost here. So I'll work with you, but I can't go that far. And experience, our customers tell us, and this is their experience, if you have some logic like that, when they come asking for that price decline, they'll work with you. And they'll go to somebody else who just says, okay, you're my number one customer, so I'll do whatever you say. You can manage this by knowing these numbers. Interest rates have risen clearly. What you're looking at here is bond yields inverted on the right-hand side. So you have a 0% rate of interest at the top, you have a 6% rate of interest on the bottom, and we're comparing that to manufacturing. And bond yields leads the manufacturing trend line by 30 months. And you can see the most recent bend in the manufacturing, the dark blue line, really ties in nicely for when those interest rates started going up. And you can see from the blue line that we have some more pain ahead of us when it comes to manufacturing in the US. There are people out there, economists, modern monetary theorists, who like to say, interest rates don't really matter. You simply get used to them. And in the long run, we do get used to them. But in the short term, they sure as heck do matter in terms of these trends. And we got to pay for all of this interest rate rise. I'm going to pay for it by declining manufacturing activity. Same thing here with CapEx, except this time I'm using bond yields instead of the US government 10-year bond yield. And it's the same story. Bond yields go up, cost of money gets more expensive, capital goods tends to take a hit, particularly when profitability is running below year-ago levels at the same time. All of this is a heads up to why we expect 2024 to have some pain associated with it. Inflation is going to remain calm through 2024 and likely into 2025. And that's what the blue line is telling us. The blue line is government spending. It says total government, but it's really total federal government spending. It's a 312 rate of change. And right now, spending is running 8% below where it was last year. But it's going to bounce up because you've seen the infrastructure bill, you've seen the Inflation Reduction Act, you've seen the CHIPS Act. You know what all of that's going to cost, not to mention all the other fund programs that the government wants to engage in. Blue line's going to be going up. When it does, you look at your watch and you say, okay, in about 2 years, we're going to see inflation start to head up again. And that's going to mean interest rates are going to start heading up again. But in the meantime, interest rates should be able to ease down. We have a yield curve situation here that is less than 100 basis points, and that's important. It used to be more like 150 to 200 bips spread between short-term interest rates, 5.53%, that's the 3-month Treasury bond yield, and the 10-year bond yield at now 4.61%. This is where ITR goes out on a limb. We expect that the Federal Reserve is going to lower interest rates over the course of 2024. Whether they start in the first quarter or the second quarter, I don't know. They're committed to holding right now. There's still talk that they may raise rates one more time in 2023, the December meeting. They may. I really hope they don't, because we need to close this inverse yield curve, and we're going to close it by the Federal Reserve dropping those short-term Fed funds rates, which have a direct influence on the 3-month Treasury bond yield. And the sooner they get through their heads that they need to drop it by at least 100 bips, the better off we are all going to be, and the better off the economy is going to perform in 2025. It's not just a pipe dream, by the way, which is an interesting expression if you think about it, but it's not just a pipe dream. If you follow the Fed, they have the dot chart there, and where each voting member of the FOMC says where they expect interest rates to go. And they have built into their thinking anywhere from a 50 to 150 basis point decline in interest rates in 2024. And they don't commit to a timeline in 2024, but they are committing to a decline in interest rates in 2024. When that happens, all sorts of more rational things start to happen, including credit conditions easing. If real incomes are continuing to grow, consumers starting to feel less pressure, able to borrow more, and we'll even see some easing in the long bond So we need declining short-term interest rates. So even though it's not the majority opinion, I think it's worthwhile if you ask yourself, how can you take advantage of declining interest rates in 2024? How could that shift, which most people are no longer looking for, it seems, most business people are no longer looking for, how can you take advantage of it coming through? And I had to qualify, most people aren't, because Wall Street's building in I think it's a 22% probability of interest rate decline in the second quarter of 2024. So there are people thinking along these same lines. And as I showed you, banks have already tightened credit sufficiently to induce a recession. I update all of this material every Friday it takes 3 to 7 minutes. We record what we call Fed Watch, and it goes out on YouTube. You can find a link to it on our website, itreconomics.com. It is absolutely free. We just know that it's a nice, concise way to summarize what has gone on, but more importantly, what it means going forward. And I know a lot of people tell me they watch it on Saturday mornings when they're having their morning coffee. And I think, well, that's probably better than watching cartoons anyways, but I guess I'd find better things to do. I'm going to run through the U.S. economy, some key points. One of them is that real incomes are going up. Real simply means adjusted for inflation, whether you include with government assistance in terms of the transfer payments or without government, which is that lower dark blue line. Real incomes are up. And what I'm showing with that dashed line is if you normalize for COVID with that dashed line, you see we're right back on track with real incomes going up, consistent with our long-term trend. And that's important to the story of why the recession is likely going to be mild and not a Donnybrook. This is an important facet. You'll also notice this chart starts in 1990. So when you hear some candidate for some office saying, the economy is awful, and we need to change it fundamentally because people are worse off now than they ever have been before. They're making less money than they ever have before. Their standard of living is lower than it has been. Just flash back to this chart. Americans are making more money after inflation than they have before, and they have more assets and more toys than ever before. The system is working, at least from that unit perspective. And is the consumer in more debt? Yeah, they're in more debt. That's not the issue. The issue is, can they service that debt load? And you look at auto loan delinquency up just 9 bips from October 22's 5-year low. This is not a pain point. Credit card delinquency, I have that number in red because it's going up. And I could scare you if I wanted to just show you the last 2 years. You'd see that rise. But what we do when we cut through the noise is give you context. It's still running well below the 10-year pre-COVID average. And you look at the credit card balances, and I have people all the time saying people are maxing out their credit cards all over the place. And the answer is no, they're not. They're really not. Not if you look at the real numbers. Residential delinquency loans running at the lowest level in over 16 years, almost 17 years. The only problem line on this chart is that corporate profits, non-financial corporate profits, so I'm not letting the bank's profitability problems do this analysis, is down 5.3% from the September 2022 record high. Okay. This chart is meant to show you that this consumer really isn't out there spending heavily, which is often what you read in the newspapers. And it's logical that they're not. The red line is something that we constructed at ITR. It looks at personal savings account balances for individuals. Obviously, it's personal. And we deflate it using the CPI. And take a look at 2020 on that bottom axis. When COVID hit, government was pouring out money, right? And was going into people's savings accounts. It was literally a year later when you see a corresponding spike in spending. And then retail sales, the bank account balances leveled off in 2021. You see a year later leveling off in the spending. And you've seen since 2022 a decline in those savings account balances. And we think that's going to put some downside pressure on retail sales in 2024. And this is our forecast for retail sales. And this is with inflation. And we're saying that the rates of change are going to get down to 0 over the course of 2024. So even with inflation, we expect retail sales to flatline before it starts heading up again in 2025. And that's going to be an inventory issue. That's going to be a profitability issue. It's going to be a whole pull-through issue on new orders and manufacturing. Housing, we all know, is a problem in terms of housing affordability. I'm just trying to show you that it varies greatly from one state to the next. In Wisconsin, the average household income is $30,000 shy of what that household would need to qualify for the average priced house in Wisconsin. I see just south of Wisconsin, Illinois, it's green because they make enough money by about $3,400. But it's also true that Wisconsin, Illinois, and West Virginia, and Louisiana, and Mississippi, which is barely negative, they're losing people. So that's why you have it more affordable. But in general, you see a lot paler colors in the Midwest. The extreme unaffordabilities are going to be on the two coasts. And that's not surprising. If you want to find lunacy, you go to the West Coast or you go to the East Coast. If you want to find sanity, you stay in the middle part of the country. This is slowly going to settle out over time as those real incomes rise, as interest rates, including mortgage rates, ease downward in 2024 and into 2025, and as builders start listening to the marketplace and realizing that that whole sweetheart period where there was no cost of money that allowed first-time homebuyers to buy 2,400, 2,800 square foot homes, that's not happening anymore. The cost of money and the square foot cost can only be met by lowering the number of square feet, not by lowering the square foot cost. That isn't going to be how it happens. You're just going to have a smaller house as your entry-level house, and that's going to take time to happen, which is why we remain relatively confident in the multi-family housing market. It's not good news, bad news here, I guess. Home ownership rate is high at 65.9, long-term number is 66.3. Homeowner vacancies exceedingly low at 0.8, and even rental vacancies low at 6.6 across the country. And 2/3 of all people in a home today have a mortgage under 4.0%. That's the statistic. You're going to need a crowbar to get these people out of those homes unless they are, boomers who are going to sell that house, buy a smaller home and pay for it in cash, because they're not going to swap out. Who would want to swap out a 4% mortgage for a 7.5% mortgage? You have to have some compelling reasons to make that economic move. I already talked enough about manufacturing weakening. Here's another leading indicator signal. When you get the charts, we'll be able to see our forecast for non-defense capital goods new orders. This is something that comes right out of our ITR trends report. It's one of our many at a glance tables, and this happens to look at manufacturing. And when you get this, you can read all the text, but at first sight, it's pretty easy to read. Red is phase D of the business cycle. That means recession. So metalworking machinery new orders are already in recession. The current 12/12 is already negative. But you see all the other rows, how much red is showing up in 2024. The slowingness that is the orange colors turns into negativity in 2024. And you can see all the green that lights up the board in 2025. It's just a real easy dashboard to look at. And we have it for construction, we have it for financial indicators, etc. You can cut through the noise pretty easily when you just look at the trends. Powell is right. Consumers hate inflation. I think that's part of why they're so negative with their confidence index and their expectations index. The good news is you can safely ignore those. We're bothered by the weakness in manufacturing and corporate profits. People who already made CapEx expenditures that had the foresight to do that a year ago or earlier are in a really strong position, proving themselves to be very prescient, because, as I told you, CapEx is going the wrong way now for two very good reasons. So you're going to have a technology, you're going to have a capacity advantage over a lot of your competitors if you made the right moves. Here I'm showing you that in terms of people, participation rates are back above pre-COVID levels. So much for the great resignation and people never coming back to work. They are back to work, folks. They'll come back even more. We're still running a little bit below trend in some areas. It's true, 16 to 24-year-olds don't particularly like to work, certainly are not at the pace that they're used to pre-2000. But I don't buy into the fact that they're lazy. I think it's because they're smart. They know they can get a loan. They don't need to work, and they know that they probably don't have to pay back that loan. So they're just playing the system. They're gaming the system. And I'll let you draw your own implications of what that means if we're going to have universal free college available. Here's that private sector one that I was talking about, and we're just a little bit below our long-term trend. And this is what the Federal Reserve is fighting against. And given what we see in the mildness of the downturn, we don't think it's a fight that they can really win. There are going to be more layoffs coming up, and you're going to have to decide whether you can scoop up some of those people because you have your eye on 25, 26, 27, 28, 29, or whether you're going to decline. If you're a distributed workforce, all those high-tech IT folks are ripe for the picking. And you can even entice them back to Milwaukee because the cost of living is so much lower in Milwaukee than it is in San Diego or LA or Portland or Salem. And you can have a real nice standard of living in Wisconsin. They're available. I'm just encouraging you to make that move. In terms of the stock market, I just want to get some of the noise off of there. The US is that orange. We've clearly been the best play going back to 2009, that trough. You can see where Germany's gone. You can see where the Shanghai Composite has gone. I continue to think, and Chris, you're going to get to chime in here momentarily. Well, I guess if you're afraid, you could say that means the U.S. has the biggest fall ahead of us. I don't see it that way at all. I think that we've capitalized on what could be done, and we have the demographic trends to support ongoing growth, whereas China and Europe are going to have a more difficult time supporting higher and higher valuations going forward. You can read through this. I don't want to cut into Chris's time when you get these slides. It just summarizes everything that we've been talking about so far. I want to talk about two long-term pressure points. Demographics, we've already touched upon. I don't need to go there, but I want to talk about inflation. I want to talk about the national debt situation. This is our inflation forecast out through 2036. And you can see toward the end there, and this is a 12 over 12 rate of change, so it'll happen sooner for the 112 rate of change. Inflation turns into deflation, and we've talked enough about the mechanics of that, but that's a very real wealth slayer if you're not ready for it. That's the easiest way I can put it. We're going to see another rise in inflation, probably up to levels where we just saw because of COVID, and there's going to be an attendant rise in interest rates. There's going to be all sorts of tweaks and distortions because of that. And then that's going to get us into a deflationary mode that is probably going to extend beyond 2036, should extend for years beyond 2036. And that's a whole new paradigm for how to be investing, how to maintain and even accumulate additional wealth. And so much of it has to do with all of this public debt that continues to mount and mount and mount. And you'll notice that it really, the separation off that x-axis becomes most pronounced beginning in 1980, and it continues to grow relentlessly since 1980. And we've had some great presidents, we've had some awful presidents over the years, and there's one thing in common. This national debt continues to climb, and ever since the Great Recession, it's been climbing at an accelerating pace. The only year it went down, not just a quarter, but a year that it went down, was under Bill Clinton. Say what you will, at least we saw the debt come down on his watch one full year. But I also think he was really busy that year, so he wasn't paying enough attention to really cause some havoc like every other president has done since then. Republicans and Democrats, folks, you can label these administrations, color them, and the trend outcome doesn't change. And we don't think it's going to change with this election. despite the, as Vice President Pence put it, the chaos caucus in the House. This has been going on for too long, 40 plus years now, that to think that we're suddenly going to find a case of fiscal responsibility and change how we run this country. And that leads us to some serious issues in the 2030s. So Chris, I'm going to turn myself off and let you take us home. And then we'll get
Ryan,
into the
before you go, just one quick question about that, because that last chart is, and I think I can speak for everybody on this call, was just like absolutely, fear heights, that scary number. What does it really mean? I mean, like, or when does it really matter? When is people have been talking about the debt for a while. I mean, is there a point where we just hit the wall?
Yeah, there is a point when we hit the wall, but we don't know exactly when. What it matters is this, and that's that red line. That's April 2009. In April 2009, our net debt exceeded 80% of our nominal GDP. And based on 800 years of economic and financial history compiled by Princeton University, once you hit 80%, there's a price to be paid for relying on leverage and not living within your means. And it's only a matter of time before you have a day of reckoning in terms of that. The only country that's ever come back from being over 80% was Sweden. They went up to 83%. They got a case of fiscal responsibility, and now they're running in the 40s, I think. So a socialist economy figured out how not to do this to themselves. Yeah. When does the day of reckoning happen, and how does it all get reconciled? We're still working on that, Chris. The fact that China is such a basket case buys us precious time. But if China stops investing and Japan stops investing and the Netherlands stop investing and US stops investing, and all we end up with is hyperinflation and an increase in cost to our national debt, and that's the Achilles heel, right? Then the government has to either do one of two things: decrease spending because they have to cover the cost of this national debt, or they're going to have to raise taxes. Either one, you pick one of those two and you're hurting the economy. This is the third rail, whether it's because people no longer lend us the money, or because the cost is such that we're going to have to do one of those two latter actions. When exactly? We think it sometime in the early 2030s. We haven't changed our mind about that.
Right. Isn't that why, like, Moody's just downgraded the debt, because they felt like that those two polar opposites, spending or tax. I mean, we don't have the leadership or the courage to really tackle either one of those things.
Correct. And unless you're a modern monetary theorist, aka money magic tree devotee, you know that this story has never ended well. And just because you're the United States doesn't mean that it is going to end well this time. Okay.
All right. Well, I'll go through some things fairly quickly, and then we'll get to some more Q&A with Brian, because I think that some very valuable insights. But I want to talk a little bit about what we do at the Bear Generational Wealth Group. We're called the Generational Wealth Group because clients we work with generally have $25 million in wealth that they've accumulated, wealth that's going to outlive them, obviously generational type wealth. We do a lot of things, from data aggregation to sounding board. What I'm going to focus on today is financial strategy. When clients come to us, they want to, our goal is really to help them get to where they want to go next. We do that really by focusing on a roadmap. And one of the things that we started doing recently with these presentations with Brian is offering up that we would do for anybody, regardless of what your wealth situation is, a draft roadmap. If you want, you can indicate that during the survey if you're interested in us following up with that. And that's hopefully it meets my own personal goal of trying to be a resource to people and help from an educational standpoint in any way that we can. Why do we focus on, some of the things that ITR talks about in the cycles, and, what noise canceling? It's really because research tells us that there are human beings have come with 180 different cognitive biases. And some of these biases help make good decisions. Some biases help make bad decisions. Some work in some environments, some, not so well in other environments. All of our clients are entrepreneurs, and the four that we see all the time from our clients, because their strengths as entrepreneurs is optimism, overconfidence, illusion of control, and anchoring. Anchoring is the one I'm going to talk a little bit about right now, because that's a big weakness as an investor, big weakness in planning. Great from an entrepreneurial standpoint, but really when you think about cycles, people have a tendency to think that when we're on the top of a cycle, that's going to keep going, and when we're at the bottom of a cycle, that it's going to keep going in a negative way. And so the planning we do strategy is really to help people, kind of cancel out those cycles and get out of that anchoring bias. And why do we look at the world in terms of cycles? Well, I'm showing you the S&P 500 10-year rolling returns. I could put up any asset class; they all look like this. Things go in cycles. I mean, so we see that up and down, and we see it on a regular basis. So we start each quarter with our clients, and we talk about where are we within the market cycle. And the reason we do that is because when we're at the top, okay, that's a time to decrease risk exposure. It's a time to increase liquidity. And when we're kind of at the bottom of the cycle, that's a time to start increasing risk exposure and decreasing liquidity. And so where are we now? Well, we spent this year kind of in a weird situation, because after Silicon Valley Bank, a lot of fear of recession. We were definitely in an area of fear back in March, beginning of the second quarter. We quickly moved to optimism or relief when those things didn't materialize, and we ended back in fear after we went through the market correction that we experienced in August. I mean, we're probably going to kind of move back and forth in there, but we're still all in this area where we tell our clients that we should take advantage of any opportunities that are created to get on target and to take advantage of that, so we move up the other side of the cycle. Okay, so Brian's talked a lot about coming softness, and when people come to us, after these presentations that we do, they say, well, I really paying attention to what Brian and ITR are saying about the next recession. I'm paying attention to what they're saying about the 2030s. I'm concerned about my business. How should I allocate a portfolio? And so we spend a lot of time talking about this. And what I'm showing you on the chart right now is basically for the asset classes that are listed, how they did in the last 6 recessions. And you can see that bonds, gold, healthcare, dollar, all on average did pretty well during recessionary period of time. And the 2030s or any depression is really just a very long recession. And so that's the type of allocation or the assets that probably should have in a portfolio at that point in time. And but the key thing here is you don't want to sit and go, oh, I want to move my entire portfolio into those things, because you don't know them. You don't know how long. Look at the period in the 1990-91 period of time. We saw the stock market go down then. It dropped almost 20%. That was for those of you who were around then, that was right before the invasion in Iraq, the first Gulf War. And after the invasion started, the market took off, and we ended up the year or that period of time with a 27% return in the S&P 500. So you can have very short impacts. Those tend to create opportunities. So really the whole point in creating defensiveness in a portfolio is so that you have the assets, the liquidity to take advantage of those downturns. And then you got to take advantage of it. You got to invest money when nobody else wants to. As Warren Buffett is fond of saying, be greedy when there's blood in the streets, and that's or fearful when there's not. So that's the way we want to look at the world. Okay, and the reason for that is through thick and thin, stock markets moved up. We've had the crash at 29. We had dot-com bubble. We had the great financial crisis. We had currently we have Ukraine war, Silicon Valley Bank, the war in Israel. I mean, so we got it all coming at us all the time. Pandemic, and yet over long periods of time, the economy is going to grow. New things are going to happen in the economy. One of the things that we are looking at is that demographic shift. And so that was clear that Brian made that point that he did. And the reason I asked that question is because people are units of demand. And if population was ever going to decline, then this probably couldn't exist like this. But as Brian mentioned, it's not that population is going to decline. It's just the way that that it's going to be distributed. Okay, so, all of the people that we work with are business owners. They're either, had a partial liquidity event or they're still operating a business. And so years ago, we started looking at this back in the credit crisis times. And so Brian and I decided to write a paper called Asset Allocation to the Business Owner. And lately, a lot of folks have been asking about that. Well, how do I allocate around my business? Or, what do I do if I'm going to keep running my business? Well, the first thing you want to start with is over here. These are the steps. So you start with your balance sheet. Always got to figure out, like, where's my balance sheet? How does my business fit into that? And what kind of cash flow you have? Is my business throwing off cash that I can use to create another type of portfolio on the side, or do I want to keep investing in that in my business? And then the business cycle. So the folks at ITR can do a wonderful job of helping you figure out, how does your business work, or how does it function within a different cycle, or what are the things that are indicators for me to know where I'm at in a particular cycle. And then you use that information to create an asset allocation. So what we're showing you with this right here, this is just like, how does a particular business correlate with other assets that are out there? So then we can think about, how do we put those together? A great example of this was back in the credit crisis time. Had a client who happened to also be a friend, had a big real estate company out in the East Coast, home builder, and he's like, I'm throwing off a lot of cash, and I like try to figure out what to do with that. And I said, you know what? We're going to help you build a portfolio that will operate differently than your real estate company does. And so you'll have that, and we'll build it up, and that'll give you some diversification. And the thing about that was, it was really fascinating to me, because right before the peak of the housing market, he calls me up. He goes, you know what? I don't know why we're doing this. I can make more money just taking the money and putting it, buying more real estate, building my real estate company. And I said, you know what? That's not the point. The point is to have assets that behave differently than real estate, differently than home building, so that, if anything goes wrong, you'll have those. And what happened? We all know the story there. Housing market gets absolutely creamed. This individual was fortunate that he had that portfolio and was able to liquidate it, invest into his business, and then grow the business. And he's in great situation today, because that market just kept going, but he was able to survive. And so that's really what we want to think about when you're talking about, if you're going to continue to run a business through the current environment, or the new environment that Brian is talking about. You want to make sure that the assets that you're building outside of that are going to behave differently than your business does, so that you can make it through that particular environment. And that's what we help people do with the strategies we develop. When we have I mentioned the roadmap that we do, and we do a draft roadmap for individuals that come to us. And this was somebody that came to us. He goes, I'm trying to figure out how much I need, I might want to, I've heard Brian talk about the 2030s. I think I want to sell my business sometime in the near future, and I got to figure out what I need for this. And so this particular individual, he's thinking about, well, he get $9.5 million for his business after the sale, after tax sale proceeds, spends about $400,000 a year. And we inflate that number up and run it in an uncertain world. And what I mean by an uncertain world is, this is really a picture of a Monte Carlo analysis, or a roadmap. And you have various outcomes that you have. You can have really good outcomes. You can have really bad outcomes. What we're concerned about is that this is a 30-year time horizon. So a 55-year-old individual going to live to be 85 years old. This is the critical point. Where is, and we call this busting, where is the plan or the roadmap going to bust? And if it's going to bust sometime within the horizon, that's a bad thing. And in this situation, there was a 50% chance of that busting, or 50% chance of success. And that's not where we really want to be. Where we want to be is over at 80%. And to get to 80%, this individual, we come back and say, hey, you're in good shape overall, but you got some work you got to do. You either got to find a way to get your business up to a value where you can sell it at $11.2 million to have an 80% chance of success, or you got to think in terms of your long-term spend after you sell it. It's got to be dropped by $60,000 a year. Well, nobody really wants to cut back on the spending. So in this particular person's case, he thought that was great. He's not going to sell his business today anyway. When he came to us, now he knows, I got to get this much for it. I got to do these things to grow it. And I know where I'm going to go with that. Okay, so I said we're the Bear Generational Wealth Group. Our clients are creating wealth that's going to outlive them. This is an example of this. This is wealth that's going to outlive somebody. This is like starting with a portfolio that's, $25 million. You can see it never comes down here, never going to bust. And it could possibly get to very, very high levels. This is wealth that's going to outlive this particular individual. And there's only 4 places you can go when you've created wealth like that. You can give the money to the government. You can give your money to your heirs, you can give it to charity, or you can spend more during your lifetime. Okay, these things over here. Planning comes into place. That's estate planning with trying to minimize the amount of money that's going to the government. Everybody pretty much wants to do that. But sometimes is money going to go to your heirs? Well, you may have already given too much money to your children. So you want to make sure you plan for that, and how do you educate your children as part of that. It's all very important to think about. It's also important to think about charity. I mean, being a philanthropist is not an easy thing. So you can create the structures to give away money and be tax efficient, but you really got to have some thought. There was a paper, if you're interested in it, we can make it available to you, that we wrote, really that it had to do with philanthropy, mission-driven approach to that, and that's something that we can talk about. That was like kind of the giving while living before it was even popular. But one thing I always talk about with everybody, spend more during your lifetime. I mean, so your kids are going to spend it, or the government's going to spend it, or the charity's going to spend it. So I have a client who, he said, after you said that, those 4 things, I think about that all the time. Midwestern based, you kind of not wanting to spend a lot of money, but or never thought about, would I ever fly private? And what occurred to him is that he's only got so many hours in the day, and flying private and spending that money, okay, I can justify doing that. So spending more money during the lifetime. And this is, I'm going to talk about this a little bit. This is so when you think about, well, I'm going to sell my business out in the future, and I want to sell it sometime before 2030s. Well, Brian showed a really important chart right at the end of that, and we might bring it back up if we have time. But he showed inflation coming down to about 25, and then going back up really through all of the decade out before the 2030s. So that point in time where inflation is going to be high is really at the early part of the 2030s, but it's rising the whole way. And so valuations have a lot to do with what the inflation level's at. And what I'm showing you is just for the S&P 500, private businesses, are some function of the number that's on the screen. But if you look at this here, you have 0 to 2% inflation. You can have valuations that are fairly high. This is where we are right now, about 3% type inflation, a little bit more than that. And where's the valuation for the S&P 500? It's right in here. Okay. When we were at a 4 to 6% level of inflation, it was lower than that. Now, if you think about where Brian's talking about the inflation going back to that 6 to 7, that's a 30% drop in the PE multiple. So a 30% drop for a private business would be like, okay, say that today you've got a business and you've got EBITDA of $5 million, and so you can get a 10 multiple for that. That means you have a business that's worth $50 million. That's great. So that's congratulations. That's awesome. But you might be looking at, I've got a ton of opportunities in front of me, and I think I can take that, I can grow that $5 million to $7 million. And so I want to sell it when I have $7 million, because then I can get a business and sell it for $70 million instead of 50. Well, you're thinking about something there, and you're thinking that the 10 PE is going to be the same down the road. But if we have inflation that goes up and that PE drops to 7, you're going to end up selling that business for $49 million, which is basically what it is today. So that's something to really pay attention to, like in terms of what you're going to do and where you're going to do it. And we'll talk a little bit more, because somebody asked a question about how to allocate for that time, and I'll spend a little time on that in the question and answer. But I want to jump into so I want to stay on our schedule here, but jump into the question and answers right now with Brian. So Brian, if you come back on, we have a bunch of questions that came in before the presentation, and some that came in during. And so I want to make sure one that came in during that, I want to just, you might want to address it just because it's a matter more of a technicality than anything else. But when you're showing the CPI chart, is that like an adjusted CPI chart? Is that like, so, because I know the Federal Reserve over the years have made all sorts of adjustments to CPI. What are we actually looking at when we look at that number?
Okay. First, it's not the Federal Reserve that would make changes in the formulation of the consumer price index. That's done by the Bureau of Labor Statistics, which is part of the Department of Labor,
Right.
totally different part of government. And no, when they change the formulation, and they do that from time to time, they recalculate it back through time as much as they possibly can to normalize for the change. Sometimes you'll see the government, like for the unemployment numbers, run two different measures in parallel, and that's been done with the CPI also. But it's really a better measure today than it was 20 years ago.
Yeah. So you talked a little bit about population, labor. So and I think over the course of this year, it's kind of interesting to me because everybody was talking about AI at the beginning of the year. I don't hear. I mean, it's still talked about, but it seems to maybe ebb and flow. But what impact do you believe AI will have on the job market and the labor market and population, et cetera?
Very complicated question and answer. So I'm going to try and give you what we call the D version, the soundbite version, Chris, and that is, it's part of the creative destruction process that Schumpeter talked about, that very famous economist Schumpeter. It is going to create more jobs than it will destroy, but what gets destroyed will get more press, get more political attention, and all the new industries and new facets of life that are going to be created won't be recognized until it's in the rearview mirror. I'll give you a relatively modern day example of that. Did Lotus and Excel destroy the accounting industry? Did QuickBooks destroy the accounting industry? No, it just became a tool to use, and that's what this is what it is. It's going to be a tool that we're going to have to first make sure that it's not BSing us all the time, and then it'll just be a tool that we can use.
Okay, so somebody wants to know if Taylor Swift and Travis Kelce break up, will that have a negative impact on the economy?
No, but it probably will on the Kansas City Chiefs.
That was actually my question, but
okay.
I thought I'd throw it in there to lighten the mood, all this sort of 2030 stuff. So, people talk about the BRICS and the dollar. What do you think the impact of the BRICS is going to have on the dollar?
None. That's the short answer. I already showed you what's going on in the population of and the future of the economy in China, the biggest member of the BRICS. Russia doesn't matter anymore. So you're stuck with Brazil and India, and they're trying to expand their club because they're losing their political power base and their economic base. Brazil is mired in their own inefficiencies, which leaves us with really India. And India has to prove that they can get out of their own way. Yeah. Part of the way I answer this is I looked at bank reserves across the world, central bank reserves, and we have not seen an appreciable movement away from the US dollar toward the yuan or toward any other currency. And if we were going to see the BRICS taking on some power, we would be seeing it, I think, happening there. The fact that Venezuela is now accepting Bitcoin, and the fact that Turkey now recognizes the yuan more than it does the US dollar, those are all on the periphery. That's not really where the strong economic action is at. Bankers aren't making the move. In fact, if you look at central bank reserves across the world, the Canadian dollar has as much of a percentage of the bank reserves as does the Chinese currency. So it's just not significant at this time.
Okay, so you mentioned crypto. I mean, do you think the U.S. is ever going to have a digital dollar? I know it's been talked about. Biden signed an executive order earlier this year to move in that direction. What do you think?
And I was surprised the Republicans went along with that, as a matter of fact, because I don't see how it could be done in the United States. Because unless they reinvent blockchain somehow, your privacy rights just got tossed out the window with this digitized dollar. And what American is going to stand for that? And instead, I really applaud the Fed for what they have done, and they call it Fed Now, and it's for settling international transactions, much less expensive than using the USD, and really fast, not quite as fast as cryptocurrency, but we didn't have to digitize the currency to do it. And that's been very successfully tested. And companies, institutions that want to use it have to go through a training program because it's, it's just a whole new way of doing things. But that's the American solution to having to digitize the dollar for international transactions.
Yeah, and I don't know if the Republicans are going to let them get away with it, because they've I think introduced a couple of different pieces of legislation to kill the digital dollar for exactly what you indicated, for the privacy reasons of it. If you here's a hard question. What is the
They haven't
relationship
been hard
between
so far?
but that no, that Taylor Swift one was a softie. So what's the relationship between the Fed's ONRRP, which is, I'm guessing, overnight reverse repurchase program, their current bank term funding program, and the risk of a credit crunch?
I don't have an answer for that off the top of my head, Chris. I don't know if you do. I know I've looked into those trends before, but I haven't recently, so I don't have the updated status. So I'm sorry. I get an F in that regard.
We look at that from time. I mean, basically the reverse repos are really just used as a way for the Federal Reserve to keep wherever they're setting the range for the federal funds rate, keep it at that level. It's interesting because it got to over $2 trillion, and then they now have brought that back. It's under I know it's under $1 trillion, but I think what we pay more attention to is that the quantitative easing and really QE, quantitative tightening. So if you think about where interest rates have been over the last 15 years since 2008, the average has been about 2.5%. Federal Reserve spent about $9 trillion in terms of buying. This is part of I think what he's talking about, the bank term program, buying bonds and keeping the rates down. And now they've been reversing that. So they've rolled off over $1 trillion from their balance sheet just within the last year or so. And so we're kind of watching that, because when you have that big buyer out of the bond market, that means that interest rates are going to probably hold up a little bit higher than what's some expect, at least while they're out. But again, they showed with Silicon Valley Bank that they're at any moment's notice or any crack or softness in the economy, they're going to jump right back in with that program. So,
right.
So I don't anticipate it, I guess, being that big. So another question about the 1930s. So how will the 1930s Great Depression affect a retired couple?
I think you mean the 2030s. Although I believe you that you.
Oh, yeah, I meant 2030s. Yes, exactly. The question does say 1930s, though. I just read it. You put notes in front of me. I just read what it says. Okay.
For a retired couple, you had a chart that's key for them. You said a depression is just a really long recession, right? And you clearly identified asset classes that on average are going to hold up well. That when I went to retired people and I said, you just gave them where they need to go to preserve their wealth. And again, it's not exclusively in those areas. I get that, but you gave them a really cool roadmap right there. And when we hit the deflation period, retired people really win during periods of deflation. It's the younger people that really get hurt during periods of deflation, and business owners get hurt. But retirees do very well during periods of deflation. But other than that, I can't add to the answer that you already gave them with that great chart.
Okay. So is there a business sector that you think is going to be most impacted over the course of the next year with the softness in the economy, or, is it going to be kind of evenly distributed?
Over the coming year, probably that which lower middle income folks view as discretionary. The upper income folks aren't going to really appreciate that we are in a recession. They're not going to change their buying habits. It's going to be in that lower middle income level that you'll see the biggest change in volume in what they buy.
Thanks. That's a good answer. So somebody asked, so looking ahead, where's a safer place for assets in existing small business, or investments from the sale of a business. And, you can certainly add to this, but I'd say, a lot of it depends on what the small business does. I mean, so what industry are you in? We had a individual the other day came to us, and his company provides, products to mining, to gold mining specifically. So his business is probably going to do very well during a bad period of time, because gold will be, in demand. And so, selling that business, particularly since this person wants to kind of, go through the next environment, probably going to be in a pretty good position to do that. Now, if you have a business that is in something that's going to be impacted by it, well, then having some diversification outside of that, just like the example of the guy with the real estate business. I mean, having assets that don't perform the same as real estate is what saved him. So I would suggest the same for this particular individual.
I totally agree with you, and a lot of it has to do with the person's age and the person's health at the same time.
Absolutely. Let's see, where's the infrastructure monies that were promised?
It's more a function of the money is waiting to be deployed, but they're looking for the labor and the materials to affect all that change. They're clearly behind their own timeline, but I don't think it's a function of the money being held up. I think it's a function of getting the logistics squared away.
Yeah, so Brian, it's interesting. We have a client who's a big construction company owner in the southwestern part of the United States. And he said that, there's tons of money out there. Municipalities have money to get this work done. He said, and they go out and they bid. So they put a bid out there for a construction project, or maybe a new road. And all the bids come in, and so this particular company gets the low bid every time, but they're higher than the range that the municipality had set. So the municipalities haven't adjusted themselves to the sort of new cost structure that has to be in there. So then they end up having to go back and rebid the entire project. So he said it's taking, just because of government, it's taking a lot longer for these things to be awarded. And not that they're not going to happen. He said there's more work than they can handle. But it's just more of a government snafu. Again, you talked in your presentation about the credit markets, but maybe talk a little bit more about that current credit conditions. So what's borrowing like for a small business?
If you have an excellent credit score, and your balance sheet is strong, you can get the deal done. If you have some black marks along the way, and your credit score isn't that good, or your balance sheet isn't strong, then they're going to turn you down. They can't take the risk right now at the banks. Small businesses, medium-sized businesses, we tend to go to the regional banks and the smaller banks, right, rather than go to the big ones. And the big ones don't like to deal with the sort of small dollars that everyday companies deal in. But if you can go to the bigger banks, you're probably better off in terms of security. But the best thing you can do right now, in our opinion, to our clients, is do a really good assessment of your cash flow and your cash needs for the next 12 to 18 months, and figure out where your problems are. And if you find that it gets a little too thin, well, then have a plan and talk to that banker that you've always talked to, and see if you can't work a deal. You probably can, if you have a strong balance sheet.
Okay. Somebody's asking, from a personal investment standpoint, when to begin moving assets out of equities in anticipation of the depression. I guess I would say that it's no different than, the thing I showed you or went through about, where valuations are and where they're going to be from an inflation standpoint. Because if you're right about inflation, if ITR is right about inflation, and it's moving higher as we get to the end of the decade, the market and equities will react to that. All valuations will react to that well in advance of the 2030s. So, you're going to have some diversification of that. I would suggest paying more attention to where valuations are and how much cash is out there to support the valuations. Like, for example, at the end of coming into the beginning of the fourth quarter in September, valuations were such that the market was reasonably valued from our metric that we look at. And there was tons of cash out there. And so we're like, this is an opportunity to, if you're below allocation, to bring it up to target. And so that's what we did. And obviously people have been rewarded with that. But now we move higher and the valuation continues to climb. And we'll watch that, because if it gets too far extended, suddenly we're looking at, S&P 5,000 or something, then we'll probably be, looking to bring that back slightly. But again, it's on the margins. And again, ahead of the 2030s, we'd look to do the same thing on the margins.
And simple thought went through my head, based on what you were saying about the valuations, inflation, interest rates going up. You don't want to be getting 20-year and 30-year bonds necessarily early on in that transition into the bond market, because you're going to want to capture those higher coupon rates and the better yields as the years unfold.
Right, for sure. I mean, that's
and one of the things I love about your style is it's always a gradient with you. I mean, you're never going to go all the way over here. It's a more rational, thought out process, and that's the key for the rest of this decade and getting into the 30s, I think.
Well, we have a few more questions that they're out there, and we'll follow up with those people that ask those questions. But I always like to stick to starting on time. We started right at noon Central today. We're going to end right at 1:30 Central today, our 90 minutes. So thank you very much for joining us, Brian. Thank you very much for your comments. We'll follow up with everybody with a summary of the presentation today. The video presentation will be available. Make sure you hang around and fill out the survey. That helps us a lot. Thank you all very much.
Chris, thank you for this opportunity. Always great working with you and your whole team. So thanks.
Thanks, Brian. Have a great day, everyone.